Assalamualaikum warahmatullahi wabarakatuh. I Binti Saadon Abdul Rahman, and to all audience. We are from Group BA 2424A. Students UiTM Campus Puncak are going to share with you about Islamic Financial Systems, value proposition of Islamic finance, structure and operational mechanism of Islamic financial systems, instruments offered by the different institutions, and the comparisons between Islamic banking and conventional bankings. So, before we start, my name is Natasha Aliah binti Mohammad Ghazali. Alright, first thing first, what is Islamic finance? Islamic finance is a financial system which operating under Islamic law, therefore a Sharia compliance. Islamic financial system is just like a conventional system, which it has the features of banks, capital markets, funds managers, investment firms, and insurance companies. Next, what is Islamic financial systems? Islamic financial system is a system in a country's economy which consists of financial market, financial instruments, financial institutions, and market participants, which it operate with Islamic principles and are aimed at meeting maqasid Sharia. Islamic financial systems consist of Islamic financial institutions, which it include Islamic banks, Islamic insurance, takaful, Islamic unit trust, Islamic institution wakaf, and others finance companies. So what we are going to explain more details to you is what's made Islamic bankings differ from conventional bankings. The Islamic banking system, which form the backbones of Islamic financial market, plays an important role in mobilizing deposits and providing financing to facilitate goods. The Islamic banking system is currently represented by 31 Islamic banking institutions, comprising of 2 Islamic banks, 31 conventional banking and 9 commercial banks, and 4 foreign banks and 7 finance companies. Islamics prohibit interest, so the Islamic banking systems involve the product which do not include riba interest and which are according to the Sharia principles. Therefore, it also called as the interest-free banking. More and more customers are keen to the Islamic ways, and many conventional commercial banks are also introducing Islamic banking products, which separates from the conventional products. Many non-Muslims are one of the customers of Islamic bank. So, without wasting our time, did you want to know what's made Islamic bankings differ from conventional banking in terms of value propositions, structures, operationals, and instruments? So, let's we go further.
Assalamualaikum warahmatullahi wabarakatuh. My name is Megat Binti Fadzil, and I will continue this presentation by explaining about the value proposition. Value proposition refers to the value of a company that promises to deliver to the customer, and it should be clearly explained how a product or services fills a need, communicate with the specific of its added benefit, and state the reason why it's better than a similar product or services at the market. By now, I will begin by explaining the value proposition between the Islamic and the conventional financial. At first, the value proposition of the conventional financial is geared towards the consumer-friendly customer services that actually meant to attract more customers with the intended objective to get the profit maximization. For example, Afin Bank provide the reward point of redemption value, and this actually will put the Afin Bank credit cards become more competitive with the other banks, and as a result, it will make the bank, which is Afin Bank, become more profitable due to the people we attract with this facility. So this is the table of a reward point redemption value for Afin Bank credit cards. On the other hand, through the Islamic finance industry is not averse to the profit making. It actually more to the bringing benefit to the doorsteps of their customer in mutually beneficial manner through the partnerships modes of financing. The value proposition of the Islamic finance firmly rooted in the maqasid al-Sharia. Traditionally, it involved of ethical investing and green business. This take into the consideration of the building blocks of the modern social investing, ethic, consumer protection, community development, and also the global development. For example, Raji Bank said that it was very successful in diversifying its revenue based on due to the effort in developing the investment and banking sector hand in hand with managing the customer relationship through the meeting with the needs of their best quality and services.
Assalamualaikum, my name is Nursyamimi Binti Megat Sharif. Today I will present about the structure of bank. A structure is an arrangement and an organization of interrelated elements in materials, object or system. Material structure include man, objects such as building and machines, and natural objects such as a biological organism, minerals and chemicals. Abstract structure include data structure in computer science and musical form. Types of structure include a hierarchy, a network featuring many-to-many links, or a lattice feature connection between components that are neighbor in space. The basic difference between Islamic banking and conventional banking is the structure of how the bank is set up. For a conventional banking, the purpose of setup is to collect deposit and give loans. This is the shareholder understanding of what it should be. Two very distinct functions is collect deposit and give loans, and the arrangement is managed by a treasury function which tries to balance the return to shareholders' fund. You can see on the screen the flow of the treasury function structure. For Islamic banking, it's supposed to be set up based on the theory of sources and application of funds. There should be a single flow between the deposit and the financing's use of fund. This means there is no distinct function like a conventional banking. It is a single function where customer deposit or invest is used to fund financing portfolio or deploy it into investment instrument from which returns are derived and recognized. As the returns are determined, these returns are shared between the bank and the customer. This profit-loss sharing structure demands a different way of managing the bank, although not all Islamic banks are able to successfully pull this off 100%. In the screen, you can see the flow of the Islamic banking flow structure.
Hi, I'm Farna. So I will talk about what is operational in financial system. The operational in financial system is the legal transaction executed by a bank in its daily business, such as providing loans, investment, mortgage, depending on the focus and size of the bank. There are countless types of bank and financial institutions currently operating in the world. Each of these institutions seek to provide a specific set of service, and it is not uncommon for an organization to tailor its service to particular market or type of investor. In another sense, banking operation involve the practice and procedure that a bank uses to ensure the customer transactions are complete accurately. For example, if a customer wishes to purchase stock shares, the bank ensures that the money and stock are ready to be traded. The bank will oversee the actual transfer of the stock and fund, and it will ensure that any reporting requirements regarding the transaction are recorded. In this process, the bank focuses on protecting its client and looking for any potential threats to the client finances. Okay, so what is the difference between Islamic banking and conventional banking in operational? When most people hear about bank, all they can think about is the interest rate that come with loans. It gets more confusing when the same people hear about the Islamic banking. Most people tend to think that an Islamic bank is financial institution that service Muslim only. However, Islamic banks are open to all. In Islamic banking basis is operation on the Sharia law. It means that goods that are prohibited within the Muslim community will not be traded through this bank. For instance, Islamic bank cannot provide you a loan to start wine shop. Most of the commercial banks that have Islamic window have a Sharia advisory board that comprised of scholars who provide direction on how the financial institution should be operated. For conventional bank, on the other hand, operate on man-made law. Their main motivation is business, but sometimes it has taken the intervention of government to regulate unethical trading. These banks have lobby groups that represent their interests when they want to change law on how they operate. And some of the law are based on supply and demand force, while others are simply through consensus.
Hi, my name is Nurul Hasya, and in this part of video, I will focus on Islamic financial instrument along with the differences when compared to the conventional financial instrument. For instance, the most common instrument in the Islamic financial are partnership-based instrument, exchange-based instruments, and also leasing-based instrument. While in the conventional instruments, they are in the form of assets where it can easily be traded, such as cash instrument, equity-based instrument, and also debt-based instruments. In partnership-based instrument, I will focus on mudarabah. Mudarabah is a silent joint venture where it is typically used to finance short and medium-term investment projects. In mudarabah, the bank and the entrepreneur will go into the voluntary business association, which allows the bank to contribute capital, while the client will contribute his entrepreneurial skills. If profit is made, the parties will share the profit, and where the case of loss exists, only the bank suffers it. When compared with the conventional instrument, the big difference that we can see is in mudarabah, the bank and the entrepreneur will share the profits and only the bank will suffer losses. While in the conventional financial, usually only the entrepreneur will bear all of the losses. In exchange-based instrument, I will focus on buy al-murabaha and also ijarah. Buy al-murabaha is a type of sale in which the seller reveals to the buyer the cost of the underlying commodity and amount of profit in the form of a markup. In this sense, murabaha is not an interest-bearing loan, but rather it is a sale of a commodity for a price equal to its original cost plus a given markup. A murabaha transaction is usually executed by the bank purchasing the commodity desired by the client and selling it to him on a cost plus profit basis. Under this arrangement, the bank is bound to disclose all the cost and profit margin to the client. Therefore, the bank, rather than lending money to a borrower, they purchase the commodity from a third party and sells it to the customer for a higher price. When compared by al-murabaha with the conventional instrument, we can find it similar to the conventional loan. The key difference lies in the contract structure, where murabaha is a sale contract, while the conventional loan is an interest-based lending agreement and transaction. In case of murabaha, the bank sells an asset and charge profit, which is a trade activity declared halal in the Islamic Sharia, whereas giving loan and charging interest thereupon is pure interest-based transaction declared haram by Islamic Sharia. Next is ijarah. In an ijarah contract, one party purchases and leases out the equipment required by the client for a rental fee. The duration of the rental and the fee are agreed in advance, and ownership of the asset remain with the lessor. An example of an ijarah contract is an Islamic bank purchasing a house for a customer by adding management costs. The customer then pays a rental fees until the total cost has been paid off, at which point the ownership of the asset is transferred to the customer. When compared conventional instrument, ijarah has the same meaning as the conventional leasing, but there are some differences present. In ijarah, the leased asset is owned by the leasing bank, while it is not the case in the conventional leasing. Moreover, ijarah is a binding contract, and hence neither party can terminate it without mutual consent unless the contract is breached by either party. While in conventional leasing, the agreement gives the leasing bank a unilateral right to terminate it as its own discretion. In addition, in ijarah, penalty on the late payment is considered impermissible and hence it cannot be charged. While in the conventional leasing, penalty on late payment is charged.